Welcome, my fellow tax professionals. Today we'll be discussing the expense component of the offer and compromise offer formula. I'm your host, Attorney Robert Schaller, and the author of the course. A proper understanding of the expense component is vital to calculate the reasonable collection potential of the Internal Revenue Service. An undervaluing of the taxpayer's expense would overstate the net income of the taxpayer. An overstatement of the taxpayer would lead to a tax offer greater than is necessary. On the other hand, the overstatement of expenses would be a subtraction from the gross income, leading to an understatement of the net income. An understatement of the net income would lead to a taxpayer offering an insufficient amount in the offer, causing the offer to be rejected by the IRS. This is a key component that must be carefully studied and thoroughly understand. I hope you enjoy the video. Now let's talk about the expense calculation. The expense allowability question is one of the most difficult aspects of calculating the future income component of the reasonable collection potential formula. Therefore, tax professionals are strongly urged to complete all of the income-related courses at National Offer and Compromise Academy before accepting their first client. The offer amount must equal or exceed the IRS's RCP, or reasonable collection potential. The RCP is the amount the IRS could reasonably expect to collect through the collection process without regard to any compromise. The lump sum payment offer formula adds the net realizable equity of the taxpayer's assets plus 12 times the taxpayer's future income. The periodic payment offer formula adds the net realizable equity of the taxpayer's assets plus 24 times the taxpayer's future income. The future income formula is simple. Future income equals the monthly gross income less allowable expenses. But this begs the question, what expenses does the IRS deem allowable expenses? So let's continue to explore the expense calculation with a focus on what expenses the IRS deems allowable expenses. The IRS allows necessary expenses, but what expenses are necessary? The IRS considers as necessary expenses those expenses relating to the health and welfare of the taxpayer's family, and expenses related to the production of the taxpayer's income. 100% of necessary expenses can be deducted from future income when calculating the taxpayer's reasonable collection potential. The IRS utilizes national and local standards to impose limits on the amount of certain expense categories. National standard limits apply to categories like food and clothing, but local standards limit allowable expenses to other categories like housing and transportation. As discussed later, allowed expenses do not necessarily equal actual expenses. Now we will continue our discussion of allowable expenses with a focus on the IRS national standard. The most common expense categories limited by the national standard are food, clothing, personal care, housekeeping, etc. The expense deduction allowed equals the national standard amount regardless of the amount actually spent. For example, assume a taxpayer's actual food expenditures are $500 per month, and let's further assume the allowed national standard for food is $727 per person for this taxpayer. In this scenario, the taxpayer would be allowed a monthly food expense deduction of $727 per month, even though the taxpayer only pays $500 per month in reality. The standard proves a windfall for the taxpayer in this scenario. Now, let's change the example and assume a taxpayer's actual food expenditures are $850 per month and keep the allowed national standard for food at $727 per month. In this second scenario, the taxpayer would be allowed a monthly food expense deduction of $727 per month, even though the taxpayer pays $850 per month. The national standard now proves a detriment to the taxpayer. Now we will discuss the expense calculation with a focus on the IRS local standard. The most common expense categories limited by the local standard are housing and utility expenses and vehicle expenses. The expense deduction allowed equals the lesser of the local standard amount and the taxpayer's actual expenses. For example, assume a taxpayer's actual rent obligation is $1,300 per month, and let's further assume the allowed local standard for housing is $1,000 per month. In this scenario, the taxpayer would be allowed the lesser local standard housing expense deduction of $1,000 per month, even though the taxpayer actually pays $1,300 per month to his landlord. Now, let's change the example and assume a taxpayer's actual rent obligation is $750 per month, and the allowed standard for housing remains the same at $1,000 per month. In this scenario, the taxpayer would be allowed the lesser actual housing expense deduction of $750 per month, even though the local standard deduction is $1,000 per month. The expense allowability question is one of the most difficult aspects of calculating the future income component of the reasonable collection potential formula. Thank you for listening to this video, and please spread the word to family and friends that Do-It-Yourself Offer and Compromise Academy is available to help taxpayers find solutions to crushing IRS-backed taxes. The music for this video was provided by www.bensound.com. You can contact the Academy at its contact page at www.diycompromiseacademy.com. Enjoy the online course and keep on learning.